Okay, well, welcome everyone to the IMAP Specialist Series, Session 2, following the great session we had on Monday. Let's talk asset allocation. So today's session will be all about how asset allocation is evolving, and we'll be getting a bit more granular with our panelists today. So I'm really looking forward to today's session. I think it'll be very interesting. Once again, I'll come to this in a second, but you are welcome to ask questions throughout. There's the little logo down at the bottom of your screen there. But just in terms of introducing our panelists and myself today, my name's Jerome Lander. I'm the Chief Investment Officer at WealthLander, which is a diversified alternative fund for wholesale investors, a high-performing one, I hope, and also a portfolio manager at Dynamic Asset, which runs managed accounts for advisors. So retail managed accounts. So our panelists today, firstly, our first speaker today will be Alex Cathcart of Drummond Capital Partners. Alex is a portfolio manager and economist at Drummond. And we have Jesse Imer at Mason Stevens, who is the fixed income investment strategist, probably known to quite a few of you already. So first, we're going to have today's session, we have two 12-minute presentations. Alex's presentation is going to cover off on creating robust portfolios and optimization, scenario-based asset allocation, and portfolio tilts and current portfolio tilts and views. And Jesse's going to talk about the future of asset allocation, new thinking with respect to asset allocation, the rise of alternatives and new assets that perhaps we should be considering for including in our portfolio. So as you can see, this could be a very interesting session indeed, and hopefully it will be. So with no further ado, I will turn over to Alex for our first presentation.
Hi. We could, I guess, start at the first slide. I'm going to talk about mainly building robust portfolios and right at the end, tilts. And to start with, I guess I'll say, what do we mean by a robust portfolio? And for us, that means a portfolio that it will probably do okay across most of the scenarios, different investment environments, even if you're wrong. So I'm going to talk through some of the tools and processes we use to try and help ensure our portfolios are robust, and then give some insights into what that has meant in terms of the latest SAA review that we're undertaking, which is nearly finished. So I'll start with the concept of scenario-based asset allocation, scenario-based capital market assumptions framework. And for us, this is quite important. So obviously, as part of a capital market forecasting process, you have to try and predict what's going to happen in the future. The future is inherently uncertain. Some may argue it's more uncertain now than it has been in the past. Whether it is or not, a good way to try and capture the distribution of potential outcomes in terms of investment environments is to think about the world in terms of scenarios. So we model capital market assumptions, volatility, correlation matrices, across the scenario, a number of scenarios that we think are plausible, and have, although some are sort of more out there than others, have a reasonable probability of actually occurring over a 10-year forecast horizon. So the scenarios that we're modeling this time around this year, which are a little bit different from what we thought last year, there's 4 of them. We have Goldilocks, return to normal, volatility, and stagflation. You can probably infer from the names what each of those scenarios means, and I'm not going to go into a great amount of detail given time limitations about the nuance of each scenario. But essentially, what drives the narrative and the difference between each is the interaction between fiscal and monetary policy in what has been quite a low growth world. So we have scenarios where it all works. So fiscal policy generates a self-sustaining economic recovery. Monetary authorities come to the party, and we have a decade of no recession, quite good growth, moderate inflation, positive supply side shocks. It's essentially a Goldilocks world. The second scenario we call return to normal. And by normal, we mean essentially a repeat of what happened in the post-GFC period. So the post-GFC period was characterized by low inflation, low interest rates, low productivity growth, fiscal austerity, low everything. It was a real grind. Asset returns were good, but that really reflects the low base that we started the decade from. So this is essentially repeating that process, that period from the base where we're at now. Volatility is essentially an accelerated version of that scenario. So we have lots of fiscal stimulus, central banks hit the brakes, causes a recession, then we have more fiscal stimulus to get out of that recession, central banks hit the brakes again, and we just have this stop-start on-off period of growth, very similar to what China's experienced in the post-GFC period. So they've had around a 3-year business cycle. This is essentially mimicking that for developed market economies. The final scenario, the really bad one, the one every policymaker in the world is trying to avoid, is stagflation. And that's a world of very low growth, very high inflation, although not as high as we experienced in the 1970s, and essentially driven by policy failure. So this is where lots of fiscal spending, central banks accommodate, but it all just gets out of hand, and we end up in a world where there's not a lot of growth and quite a lot of inflation. And what does that mean for returns? We can look at the bar, the second from the bottom bar, and this is for a sort of balanced 70-30 portfolio. What does it mean? And for the most part, returns are low. So Goldilocks is good, as you would expect, but otherwise we have low to moderate and low and low. And our actual numbers, our actual capital market assumptions, are not dissimilar from what other people are putting out there. Although, and we'll talk to this a little bit later in the coming slides, what that means in practice for portfolio construction can be a bit more nuanced. So although headline beta returns to global equities are low, there are pockets of global equities that aren't expensive, and if you can cut and dice things, the outlook isn't quite as dire. And in terms of volatility, what does that mean? Well, we can see that, as you would expect across the different scenarios, Goldilocks, you have lower portfolio volatility than a stagflation scenario. It should not be as a surprise to anyone. So if we just move to the next slide, this is quite scattershot, I guess, but we're talking about the scenarios, capital market assumptions that we use to build robust portfolios. These are some of the tools, I guess, that are available and that we use to build portfolios which we think are robust. So there's 3 key elements of that for us. One is portfolio optimization, one is introduction of more complex processes, and one is the use of heuristics. So by optimization, what does that mean? In practice for us, it means we optimize portfolios against the different capital market scenarios based on Sharpe ratio as a baseline, but keeping an eye to sort of min vol, max return, and optimized portfolios as well. By complex processes, we're talking about simulation analysis. So you can see that in the chart in the top right is essentially 10,000 return simulations across one of our capital market scenarios. And what we're trying to achieve by simulation analysis is getting a feel for the distribution of potential outcomes and seeing if we can nudge the portfolio away from what an optimized portfolio looks like to essentially improve the left tail of outcomes. So that really you want to narrow the left tail and essentially widen the right tail. And there's trade-offs associated with this. The third element, heuristics, is essentially judgment calls. And hopefully judgment calls are backed up by research and evidence and process, but essentially judgment is a key factor in building robust portfolios as well. Something else to consider from our perspective, and I think from your perspective often as well, is what does this mean in terms of Australian platform investors? What are the constraints in an optimization process we need to consider? Obviously, liquidity is important. There's things like fees matter for end users. Availability of product on platform can be different. FX, currency, you need to consider currency. It's usually the second biggest risk in a portfolio after equity risk. And how do you manage currency in a portfolio where it's hard to, essentially, you can't have overlays, so you need to consider how much foreign currency you can actually remove from your portfolio given hedged and unhedged managers. And then we need to think about things like portfolio construction trade-offs. So let's consider the left and the right tail of the distribution. Credit in a defensive part of the portfolio. It essentially improves the right tail of the distribution, the medium return, but essentially swapping out bonds for credit adds left tail or drawdown risk to your portfolio. Alternatives, similarly, you can add a lot of alternatives in an optimization process. They will lower portfolio volatility, but they won't necessarily improve model portfolio outcomes from a scenario analysis perspective, because they don't have the negative correlation to equities that bonds have had traditionally. And then we need to make a decision as well. Are bonds likely to have the same negative correlation going forward as they have in the past? And under some of our scenarios, they don't. Something else, stress testing. We're required to do stress testing as part of the regulatory framework. Is it actually useful? Does it matter? You're essentially replicating what has happened in the past. With your current portfolios, you might have a completely different view about how different asset classes are going to perform under equity market drawdowns. That matters for things like alternative strategies. So you can have CTAs work really well in long protracted drawdowns, GFC tech bubble. The 2018 and 2020 busts essentially happened incredibly quickly, which makes asset classes and strategies like that really hard to actually perform. As a final cross-check, you can do weird things like simulate, and this is the chart in the bottom right, 1 million random portfolios that are 70-30, and look at where your expected return at the 50th percentile sits on that distribution, just to get a completely out-of-the-box cross-check to see if, after we do all this stuff, does it actually look okay in the end. So just go to the next slide. And then you can dive a bit deeper. So often we talk about things like, and I mentioned it before, expected equity returns being quite low given valuations. The chart on the left essentially decomposes the world, global equities into US and developed markets. And you can see developed markets ex-US expected returns are actually reasonable. So there's a big part of the global equity market that's essentially driven by US tech being quite expensive. If you believe that that's not going to be great over the next 10 years, you can still build an equity portfolio to get around that. We're worried about inflation, rising rates. Everyone's worried about inflation and rising rates. The sort of default view is to say, well, infrastructure and real estate are a good hedge against inflation. But once you sort of dive into certainly the listed part of those portfolios, as we've done on the bottom right, you can see essentially it's not necessarily what it seems. So the inflation protection for REITs and infrastructure, especially over long periods of time, isn't necessarily that much better than equities, straight equities, global equities as a whole. And certainly interest rate sensitivity for those asset classes is higher. So potentially in a world of rising inflation that is accompanied by rising interest rates, infrastructure and real estate may not be actually the place to hide there. And if we go to the last slide in my last couple of minutes, current tactical positioning, we're quite overweight equities. So from a tactical point of view, we like equities at the moment. It's backed up by sort of the quantitative signals that we use in our process and just a view that global growth, at least over the next 6 months, should be quite strong, earnings growth quite strong. So that should be supportive of equities. Within equities, we're underweight emerging markets. So the China credit cycle's peaking. Our growth barometer, which is on the top right, sort of suggests Asian economic growth is slowing at the moment. There's issues, supply chain issues are likely to hit emerging markets harder than developed markets in the current environment. So we're underweight EM equities. We're underweight bonds like probably every other investor in the world at the moment, in favour of alternatives and cash. Likely to build more position in bonds if yields sell off to something more reasonable given the current outlook for growth. And we're underweight REITs and infrastructure. In part, that reflects a view of rising interest rates. It also reflects secular themes around those asset classes. So there's potentially issues around stranded assets in infrastructure in a world where we're likely to have carbon pricing built into global economies. And obviously everyone's aware of the working from home issue and REITs, and there's longer-term issues around REITs and retail and the Amazon effect as well, which we're trying to step away from. So that's my, I think, 12 minutes, and that was my last slide. So I might
Thank you, Alex. Yeah, we'll come back to you with some questions around that. That's terrific. And again, reminder to everyone who's online and the new people that have come on, please put your questions in if you want us to discuss them in the discussion. That'd be great. And we'll move on to Jesse's presentation, please, Jesse.
Pleasure. Thanks, Jerome. And hello, everybody. Firstly, I just want to thank IMAP. This is my third or fourth now opportunity to speak and present with IMAP, and everyone's been a really enjoyable listen on both my behalf, and I'm learning a lot from the other presenters, and it's just quite a great opportunity to speak with both Jerome and Alex today, and thank you again to IMAP. So I'm lucky enough to speak about some of the most fun and interesting parts of asset allocation, so I'm quite lucky today. So I'm going to be speaking about new thinking in portfolio optimization theory, the rise of alternatives, mainly because why lower cash yields from fixed income has made us need to seek alternatives, but then also just talking a little bit about the asset classes emerging and some of their use cases. So these are three eminently suitable topical discussions at present, things that, at Mason Stevens, we have an investment platform that's got a bit more than 6 billion worth of FUM on it, but we're also asset managers, which is the team that I sit within. So we get to have kind of both these conversations. And when we're building, someone's portfolio, multi-asset portfolio, or maybe it's something a bit more bespoke, specifically fixed income, but also managing the money as well, which is quite interesting. So we're exploring how we can model the world, financial market interactions. And so if we're starting to think about new theory when it comes to asset allocation, we need to remember where we came from. So you think about modern portfolio theory. It was developed by Harry Markowitz back in the 50s. It was his PhD thesis. At the time, it was such a novel concept that his PhD sponsor, Milton Friedman, who's quite a well-known economist himself, argued that it wasn't economics. And that was 70 years ago. So at the time, Markowitz extended the body of academic literature and talked about optimal mean variance and some of these esoteric terms. But what we're really looking at doing is building the best risk-adjusted investment portfolio. So we can move to my first slide of content, please. Just thinking about the definition of what an asset class is. I've got the whole words there. We talk about a stable aggregation, has to be internally very similar, externally dissimilar from other asset classes. But the most notable thing is it needs to raise the utility function of a portfolio. And that's the thing I think a lot of us forget, in that we just want to include assets within portfolios that maybe we don't need to. Because by raising the utility, we either need to raise the return of the portfolio without a commensurate, an over commensurate amount of risk, or we need to lower the risk for a massive decrease in return. It sounds simple, but it's quite often the hardest part to come to when we're looking at assets, and why we're looking at including alternatives, for example. So, there will be times that, I suppose, when I'm talking to clients where might only need to be cash. We might only need to be nearly completely overweight fixed income relative to others. And then there are other times where we need to be massively overweight domestic equities or international equities in other alternatives. These are just plausible realities. So the holy grail of investing is when we have a unification between returns to the upside, and we have a diversification of returns to the downside. So coming back to what Markowitz was talking about in 1952, talking about building optimal portfolios, just like Alex has just done before me, we're talking about expected returns, talking about volatilities and risk factors, and we're talking about correlations, as in how does my equity portion or my domestic equities relate to my international equities, relates to my fixed income, relates to my international fixed income versus my cash versus my infra, etc. And so these three factors became known as capital markets assumptions, and we use them as institutional managers of money to build portfolios. So the obvious issue with designing portfolios that are diversified is that we'll have components that rally during bull markets, but they're offset by the diversified assets that sell off at the same time. And so this might stabilize returns and smooth outright levels of portfolio volatility, but it might not be optimal. And so we can come up to my next slide, please. Perfect, thank you. As I mentioned, a truly diversified portfolio seeks upside unification and downside diversification. It's a type of holy grail. Very hard to achieve, very seldom found, but it is what we strive for nonetheless. And so there's a recent academic paper that I just want to cite, and it came out earlier this year. So as someone who reads a lot of academic papers just to enhance my own knowledge, and I am actually writing a master's dissertation as well in economics. My favorite academics are a few gentlemen from MIT in Boston, Massachusetts, Dave Turkington, Mark Kritzman, and William Kinlaw, very much at the forefront of asset allocation theory and portfolio optimization. Now, in their paper that was produced in March, something I wrote, if you read the Mason Stevens morning notes that we receive, and we have a distribution list of about 2,000 people, if you receive those, you would have got an update about that back in April. And basically, they use Monte Carlo simulations to generate hundreds and thousands of returns, just like Alex talked about as well, when you compare assets X and assets Y, and how, if asset X, for example, was equities and asset Y was fixed income, how they relate, how their correlation coefficients relate. And the problem with this is that even though we can model what fixed income is doing right now relative to equities, and we have this environment this year that Alex mentioned as well, where if you have a rising yield curve, you have bonds that are selling off, meaning the yields are going up and the cash price is going lower, you have this interesting Goldilocks environment where maybe a 60-40 portfolio doesn't work, which is something that was touched upon on the Monday session. So as someone who manages fixed income monies, now Mason Stevens, we have a bit more than what's 1.2 billion in fixed income that we manage as an asset management business. When the market stops caring about idiosyncratic default risks, like we saw last year, we saw Australian government, the bonds trade very similar to New Zealand government bonds. And there's a lot of different factors there. We're AAA and they weren't. Forgetting about the difference between CBA and Telstra. Last year, the market just sold both, or even just ANZ equity versus ANZ hybrids, such as ANZ PD or ANZ PF or CBA PI. All of those were just reacted from knee-jerk reactions. So this old school thinking in, I suppose, portfolio optimization, that we want to have huge data sets with lots of observations to smooth, the relationship of our asset prices, doesn't really work. And the reason why we talk about TAA and DAA more and more is just because we are subject to market. We do see some large drawdowns in maybe a 3-month period like we received last year, and we possibly will in the future as well. And so hence we have this need for DAA. So the progression of all this is that if we determine that stocks, bonds and other asset classes are going to move synchronistically or they're going to diverge, one approach we've been trialing at Mason Stevens, a new approach, is a concept called a single period or partial sample regression. So this is we're trying to just address this. We don't want to have smoothed results. We want to account for large variances in results. And that way we can really come up with some really interesting and topical positioning. So in terms of what we do, it's something I've actually read about in this MIT paper that I just mentioned as well. We're finding mathematical equivalence in using relevant data and excluding less relevant observations. That way we can get a weighted average of this new subsample and find more reliable results. So in the paper itself, it uses this single period regression analysis to find a like-for-like scenario to the 2016 US election that was between Donald Trump and Hillary Clinton as the main contenders, which was, most interestingly, it was relevant to an election back in 1877 in the US, which was Rutherford B. Hayes when he was elected for his 4-year term. So that none of the academics that did this analysis had ever heard of Rutherford B. Hayes back in the 19th century. I'd never heard of him, but it was a very similar situation where Hayes lost the popular vote, just as Donald Trump did, but then to the Democrat candidate Samuel Tilden. But what happened afterwards was very similar in that he won the electoral college votes, was able to get in. He became the populist candidate and ended Reconstruction in the US, is what he's most notable for. And hence you were able to predict that upset if you use this technique. And similar to when I was using this technique last year, we're able to model that the US use of fiscal deficit spending was very much akin to what was happening during the Korean War back 70 years ago. And so hence we're able to use this single period to find really relevant observations and therefore go, okay, what happened to markets back during the Korean War? And that actually helped us outperform last year. And so another example is, something we're talking about this year already, and it's over the 1-year time horizon into the future that high grade bonds will probably have a negative return over this next year. So do you want to be underweight them? Alex mentioned this as well. I share very similar views where government issued fixed income exposure is probably going to give us a negative return over this next year, simply because there's the perception among markets, maybe not structural or fundamental in view, but the perception based on sentiment that yields are going to go high, they probably will. So hence we want to move more towards alternatives. So hence you cue now the rise of alternatives. And we can go to my third slide, please. If fixed income's no longer providing downside protection, meaning that so say you take the Australian 10-year government bond right now at about 1.6%. Sure, that can rally back down to a 1% cash yield or a yield to maturity of that 10-year bond of 1. And that'll mean that the cash price of that bond rallies about 6 to 7%, which is fantastic return from fixed income for sure. But then you're also hoping that your mark to market stays the same and that it matures towards that price, that same yield, which might not be the case. So hence we have some downside protection from fixed income right now, but not too much. It's rather asymmetric, to which in that case, it informs us that, in terms from a technical positioning, I want to be underweight global fixed income or even just Aussie domestic high grade bond fixed income. And I want to look at alternatives such as credit, maybe private credit. Maybe I want to look at hedge funds, venture capital, private equity, whatever is going to potentially meet the opportunity set that each client portfolio has. And this will depend on whether it's a growth portfolio, a balanced portfolio, a mod con portfolio, for example. But all this is quite different. So now, just speaking for something I run a morning call at Mason Stevens. 4 days a week, we have a different fund manager on. And recently I interviewed a portfolio manager named Mary Nicola from Pine Bridge over in the US. Oh, sorry, she actually works in Singapore. And Pine Bridge manage about just over 140 billion US dollars worth of fund, large institutional asset manager. And while they manage some money locally, and I believe they're in consultation with Q Super, or it might be Sun Super, apologies, I don't remember that too closely. Their main investor base is non-Australian. So you can see how the likes of a Pine Bridge, or if it was a Vanguard, a PIMCO, a BlackRock, etc., they're managing money. From their point of view, you actually want to be underweight Australian equities right now. You also want to be underweight Australian fixed income relative to other countries. Whereas from my experience, working for an Australian investor platform, but also as an Australian asset manager, we tend to have a home bias, to which we are probably underweight. We're overweight Australian exposure, whereas we probably should be underweight that exposure, and we should be more involved in US cyclicals, financials, even Spanish equities, French equities, Mexican equities. And so Alex and I, we can both do this scenario analysis, and we can develop these capital markets lines, capital markets assumptions that tell us where to go. But it's quite interesting, especially when you have to think about the currency and the exchange rates that, as Alex quite rightly pointed out, is quite often the second biggest risk within a portfolio. So coming more to a bit more alternatives and why we're using them. A lot of people, when they're talking to me and talking to Mason Stevens, they're looking at alternatives to mainstream fixed income. And so if you could buy, and we had this discussion, Alex and I and Jerome, just before we kicked off this call today, if I could buy 5-year Australian government bonds at a cash yield of a bit above 5%, and inflation was still around 2%, for example, happy days, I would probably be massively overweight Australian fixed income, because it's going to provide me the most of the diversification, the liquidity, and the income that I need. But at the moment, I'm not getting the income that I need. So hence there's a trade-off in that I'm going to give up some of that liquidity and diversification in order to buy some of these alternatives. And so people, when they're talking to me, they're coming looking for credit bonds. They're looking to buy a Westpac issued bond. They're looking to buy a Telstra issued bond, where they're receiving an extra premium, that credit risk or that increased default risk of buying a Westpac bond compared to the government. But if you're able to get, say, 3.5% in buying investment grade credit in Australia, that might be a suitable level of income from a lot of portfolios. Then they're also looking at more private credit. Now, these might be a Latrobe or a Metrics credit, for example, but they're looking at the private credit markets as a way to maybe get that 5 or 6% potentially, or even more, depending on what kind of levels of risk we're taking as well. Some others, they're using infrastructure as a cyclical play, where they're obviously receiving a certain amount of income for investing in infrastructure deals, but they have a lot more growth orientation. So hence there's got to be a different level of risk and reward based on this. It's more tactical, but it might not work. And then some others are coming to us and they're looking for more hedge fund style exposures. And this might be an Arnott Opportunities Fund, for example, or an Elliston Jade, a PE FX Alpha Fund, to name just a couple that we've been speaking about recently, just because they're different. They're a trade-off, as I said, less liquid, potentially more risk, or depending on how much risk is, might not be in line with some portfolios. But we are seeing these increasingly interesting ways to get exposure to cryptocurrency. Sorry, these alternatives. And that brings me on to one last thing I want to bring up, is just people who are speaking to us about new asset classes. And we know there's going to be more asset classes into the future, and at the moment it seems more topical when people want to talk about blockchain assets or crypto, alternative currencies. And so our house view is that while cryptocurrencies might be still more like a commodity right now, and they're not a cash asset, because they do they're not a store of wealth in that way, that they do have a lot more volatility than a generalized cash asset would. these are, assets that people are looking at bringing into portfolios. Because also from an advisor standpoint, if you said to me, hey, Jesse, I'm looking at targeting a younger, the next generation of clients that's going to be the next generation of clients for my practice for the next 20 years, what's a good way to bring them in? Now, these people might not have exposure to equities or for fixed income, and they might think that's unsexy, but they might go, hang on, I want to have a 2% or a 5% exposure to something crypto related. What kind of fund or ETF do you provide, or can you talk to me about, which then broadens the conversation to a much larger conversation about asset allocation. We kind of come full circle at this point. But I suppose the last remark I will make is that we can't throw government bonds out with the bathwater. It's just that the yield at the moment is a bit too low. But at the same point, if enough of us share that same view that fixed income returns, and when I say fixed income, I mean government bond fixed income returns are a bit too low, this becomes a self-fulfilling prophecy, because there'll be less demand. We'll likely see bond yields move higher, as in people will want to receive a return premium for investing in fixed income, which means when the yields get up to a certain point, we'll start buying them again. And then it just becomes an opportunity. So yeah, anyway, I'll leave it there, Jerome.
All right, great. Thank you, Jesse. Right, so now we have time for questions, and I'm going to kick off a question for you, Alex. When we come back to your scenarios that you're looking at the moment, which scenario do you think is the most likely looking forward? I mean, you outlined 4 potential scenarios, and thinking about scenarios with your portfolio construction. Which is the most likely?
The normal scenario was the most likely. So we actually take an average of the investment team and the investment committee. So we get everyone's probabilities to think what the most likely outcome turned out to be the normal, but lower than 50% probability for the normal scenario, and quite high for the sort of volatility scenario, which was interesting. Okay. Not much weight on Goldilocks, unfortunately.
No, I was going to ask you that specifically. Yeah, the Goldilocks got a 10% weighting or something, did it? Or
it's quite low. I think it was 15. So
okay. All right, and what assets are you seeing? What assets are you seeing as well? Maybe perhaps I'll ask that question to Jesse first as well. In terms of scenarios that he thinks are actually likely looking forward the next 5 years or so. In terms of Alex's presentation, Jesse, or some other scenario that you want to raise. I mean, which scenario are you working with as being most likely, or perhaps just scenarios which are being underappreciated?
Good question. Our house view is that we are going to end up back at this Goldilocks style environment for at least a period of time, where we can see this supply disruption causing an inflationary spike over a 6 to 18 month time horizon. But afterwards, we see that ameliorating. It's actually quite similar to what central banks' views are right now that they're espousing. But after that point, we'll still have low cash rates, likely flatter yield curves that'll provide this environment that's going to be good for equities, good for global growth. Probably going to see negative US dollar returns, so hence we want to be hedged our foreign currency risk when we are taking foreign currency exposure. But very much so this Goldilocks environment. The alternative to this is that if prices unstick. We've had sticky pricing for a number of years. And the best example of that, so if you go into a clothing retailer such as a Uniqlo, you go to buy a t-shirt, you'll see that they're all $19.95. If you go to buy socks, you'll see that a group of socks might be $19.95. You might go to buy a t-shirt and it'll be $39.95. And these prices don't change. And in a lot of cases, same with cars, the prices don't change because we've identified psychologically that you want to anchor prices at certain levels, and that induces buying. So it's going to be hard to break that mentality, where we're going to see prices move higher just because it's almost against the national psyche or the zeitgeist, just because it's not part of our nature anymore.
Right, Alex, do you have a response to that? I mean, obviously that's quite different from the Goldilocks scenario being raised there than what you just espoused. Would you like to respond to that view that Jesse's just dispute that view, obviously, given your house view is so different?
So I wouldn't say a house. So we're long equities at the moment, so we're quite tactical. I think definitely clear skies for the next 6 months is the base case view, and that's why we're quite long equities at the moment.
Famous last words there, Alex.
Yeah, I know. The benefit of being able to be tactical is you can change your position in your mind quite quickly. So that's helpful. But we from a long-term perspective, probably of controversy, we increased our bond allocation as part of this SAA review. So when you account for things like roll, so the return to a 10-year bond isn't in Australia is 1.5%. If you hold a 10-year bond and roll it, you've got roll, you've got carry and capital gains depending on the scenario, or losses depending on the scenario. So we actually increased the allocation to fixed interest relative to sort of alternative defensives in our portfolio as part of this SAA review. And we also increased the allocation to global equities and Australian equities relative to growth holds, so that we have structurally more confidence in the equity risk premium over the long term than we do alpha. So alpha is obviously, skill is more variable than a risk premium. And outside of US and US tech in particular, global equities are okay. UK equities are relatively cheap. European equities are relatively cheap. Australian equities are, relatively expensive. EM equities are relatively expensive, but the equity risk premium that those markets are expected to deliver, given where yields and cash rates sit, is in line with historical norms. So I guess that's probably a controversial view.
Yeah. Okay. Well, rather than get more into that, let's switch to some other questions. I mean, which assets are you seeing as good diversifiers currently? So obviously we're trying to build robust portfolios, and a lot of people have gone to being overweight equities, looking for more alts in response to the lack of attractiveness of fixed interest. But what do you see in terms of good diversifiers, Alex?
Bonds, it's always just going to be bonds until we hit a regime change where the inflation premium that people used to demand from bonds is suddenly returns. And I don't think we're at that point yet. It's definitely more likely now than it's been, at least in the last 10 years, that inflation actually becomes a concern because of things like US Fed average inflation targeting, massive fiscal stimulus on top of fiscal stimulus. But at least for now, if there's an equity market correction, even at 1.5, 1.6, we still expect bonds to provide some diversification. And alts are low correlation. So over the long run, they reduce portfolio volatility, and there's a benefit to that in terms of return. But ARP isn't going to rally if equities fall 30%. Illiquids, they do their thing. Their reduction in or the defensiveness is simply a mechanic of them not being marked. There's no reason why Sydney Airport should have fallen more than Melbourne Airport during COVID. But certainly that provides a visual advantage to portfolios.
Okay, and Jesse, what do you see as sort of good ways to bring in diversification?
Yep. So we still like fixed income as that diversifying asset. There is really no alternative that provides liquidity and just diversification trade-off. We're just having to go into a different style of fixed income. So say, for example, as someone who manages, between myself and my team, we manage more than $1 billion in fixed income. We just have to be more active because there is this massive, I suppose, asymmetry or market opportunity in fixed income that a lot of the big buyers of these assets, central banks who are price insensitive, bank treasuries who need to hold HQLA, which is high quality liquid assets, as part of APRA's regulation. And then there's also large sovereign wealth funds and insurers who also have to hold them for very similar reasons. And so if you've got price insensitive buying, it generally means that there's opportunities for nimble managers to step in and take advantage of those opportunities. And so we do that in our headline product, which is the Mason Stevens Credit Fund, which is one of the top performing funds in the market, and we do that within the credit bond space. But then if you're looking for other alternative managers, that are buying sovereign bonds, you have like a JCB Dynamic Alpha, for example, or a Coolabah Capital Smarter Money Long Short Credit Fund, for example. And these are just managers who are they're buying fixed income, but they're managing it in a much different way. And so hence we see that you need to be a lot more active in fixed income, and you need to be buying these absolute return fixed income managers rather than having passive exposure, say, to an Ausbond composite, where you're going to be long duration.
So you're much more of a believer in extracting alpha than Alex is, from the sounds of things. Okay, so
we definitely believe in alpha. we have big, definitely on the bond side and the equity side, we have active managers in the portfolio for sure.
Okay, and you mentioned before, Alex, in your presentation that there's this very even though the equity markets generally are expensive, if you go to a more granular level, you're able to find value. You expressed a view around ex-US as being one way of doing that, but just in terms of sectors you think investors should have exposure to within their equity allocations, I mean, where are the opportunities? Which sectors are actually long-term, medium-term cheap in your view?
Depends on the time horizon. So we currently overweight value names, value managers, value sectors, because we believe, at least in the short term, we're part of this big inflation trade. But longer term, it's hard to step away from US big tech. So US companies the last decade have dominated. There's a reason for that. The regulatory environment's favorable, at least for now, unless we start to see privacy legislation, anti-monopoly legislation. The smartest people in the world still want to move to the US and start companies. So longer term, it's hard to say that US tech isn't a good place to be, particularly if we have a sell-off in yields, discount rates normalize to something that's more sustainable long term. The companies re-rate a bit, and then you can buy back in at a more reasonable multiple and hold for the long term. So that's I guess a central case strategy path. Don't believe that value is essentially necessarily going to deliver the return premium that it's modeled to prior to 1994 Farmer French paper in the long term.
Okay, yep. Okay, bit of a disruption coming in. And Jesse, do you have any views on that in terms of areas of the equity market to, quickly that you'd like to sort of espouse?
Yep, similar in a way, it turns on that time horizon. If it's a short-term time horizon, we're similar. We'd like that value tilt this year, just because while we don't think yields are going to move much, they're going to move a little higher. They ultimately will come back down as we enter this low growth environment, and where the sheer amount of debt in the market is going to be prohibitive to future growth. Hence this year, yes, absolutely can be long value, but then long term, you have to start looking at growth. Somewhere I slightly differ to Alex as well is that we also like, maybe, well, I actually didn't mention it, but we're more focused on quality as well. Whereas we know that this is gathering momentum behind ESG mandates, and ESG tends to invest in higher quality factor companies, then there's going to be a growing momentum behind value factors, which is going to basically provide the performance just because of fund flows. And they might actually perform well as well, but they also will do well because there's more money buying into them, hence market capitalizations will grow over a longer period of time as well. So hence growth and quality are two of the major equity markets.
Mm-hmm. I mean, when you brought that up about ESG, are there anything else you'd like to comment on about that? Obviously, there's a lot of flows of funds towards, or a lot of talk around flow of funds towards ESG funds. And obviously the degree to which funds are actually ESG is debatable, as opposed to it being a marketing tool. But there's obviously a genuine push there as well. Do you guys have any views on whether ESG should be incorporated into portfolios as a whole, should be considered separately? Whether impact investing being the real ESG is sort of something that people should really consider, as opposed to sort of, just tinkering around the edges with their current sort of allocations?
It probably comes down to your client base, right? If you had a client base who deeply care about making the world a better place, and if there was a potential trade-off between returns and a social impact, a non-economic impact of an investment, and they're happy to see a slightly lower, it doesn't have to be, of course, but a slightly lower return based on a better social impact, then you have a client base who probably should be more of an ESG bent than some other client bases who might not be as worried or be having the same kind of care, where maybe the economics of a portfolio matter more to them. But it is interesting just from a platform side as well, because we have so many people saying, hey, can you help me, what rating would my portfolio have? And maybe they want to use a Sustainalytics or an MSCI as their rating house, who provide very similar to like a credit rating. You can get a AAA down to a D kind of rating on ESG scores. More and more people are just coming to us and saying, and these are dealer groups and family offices all around the country saying, hey, what can we do for this portfolio? Or can you run a screen for stocks? Maybe I want to buy have an equity sleeve that's going to have 20 stocks within it. Can you tell me what my weighted average ESG score would be? It's very interesting.
Yep. Okay.
I think there's certainly tons of greenwashing, right? There's plenty of big funds that have massive ESG teams that have absolutely no input into investment decision making that hit up the conference circuit. Like that exists, and that's logical from a marketing and product perspective. More and more, I think we'll see integration of ESG within investment processes as people actually figure out a way to do it that makes sense. It's obviously, like, it's not new, but I think people taking it seriously in terms of the way they manage money is new. And there's certainly a separate issue, which is product. So I don't necessarily think you need to have a separate ESG product unless your end investors demand it. But I absolutely think you can't ignore it in your investment process, like you couldn't ignore valuations or an investment outlook or any other thing that's common sense. Like, obviously, things that are related to ESG matter for the earnings of the companies and the credit rating of the companies and everything else that you invest in. So you would be mad to ignore that in your investment decision making.
Yep, another factor to consider. Okay, look, obviously, in this aim of building robust portfolios, I mean, one of the issues that investors, certainly I perceive when I look at most diversified strategies and funds and model portfolios and so forth, even during the bull market the last few years, even though they manage risk, generally always manage risk well because they're diversified. One of the issues is they're just too low performing. So, and certainly that's one of the reasons I started WealthLander, to address that issue. But how do you guys perceive that you can make diversified strategies and diversified funds better performing? Looking forward, we've obviously got an even worse environment in terms of prospective returns. So it's hard to imagine that most diversified strategies are going to produce better returns than they have in the last few years. So if returns are going to get even lower, I mean, how do we address that issue, just in terms of the return issue that's coming out of portfolios going forward?
I think obviously fees, but that's probably rocks being squeezed as hard or nearly as hard as it's going to. So be aware of your fees, because that's obviously a risk-free way to reduce or increase returns. But more importantly, let's not be static. Like, it's interesting to think that you wouldn't pay or expect an equity, like, we're all sort of fund-to-fund multi-asset managers in this virtual room at least. Like, you wouldn't expect the manager you invest in to just be static and outperform the market or deliver good returns. So the ability to be active is certainly, you would hope, a return advantage in the future. The return, the expected, say you have a 60-40, 70-30 long run expected return of 5 or 6% at the moment, which is sort of 2/3 of what it has been over the last 20 years. Like, it's obviously not going to be 5 or 6% in a straight line. Like, so there is definitely capacity, if you think you have skill or if you think you have a good investment process, to generate returns on top of that from an asset allocation perspective, and returns on top of that from an active manager perspective as well. And that's an advantage, as well as I would suggest smaller, more nimble boutiques, if you have the capacity to invest in smaller, more nimble managers versus a $300 billion pension fund that can't really wear any tracking error.
Yeah, I mean, Jesse, do you have any thoughts on that in terms of how we can improve portfolio performance going forward?
Yeah, I'll bring up Alex's last point as well, because a lot of my clients, they'll benchmark themselves against a Q Super, Sun Super, Hester, Vic Super, whoever. And if you're managing those tens of billions, or in some cases more than $100 billion, it takes a long time to steer that ship, and they're mostly got to be SAA based rather than TAA. So hence, they can move some things around the edges, 1 or 2%, but they're still moving multiple billions of dollars to make any meaningful change. Whereas if you're a family office that's got 20 mil, or you've got a financial planning practice that might have 100 mil, several $100 million, you can make meaningful change just within a couple of days by selling out in a 10% of a portfolio and redeploying it the next day. So hence, if you're looking at this last year, pre-COVID, in February, you started seeing a lot of numbers come out that were pretty scary from China, and going, okay, if that's got to affect me, then come March 8th, you probably could have been largely divested from a lot of your positions that were inherently risky in I suppose, in terms of the sell-off of March and April. And so you can make this meaningful change. So hence, there is definitely a need for liquidity going forward. And I also see a period where active managers, there'll be almost a resurgence of active management, where we've moved more towards passive over this last decade. There will probably be a period where active management helps as well. And similar to my sentiments about fixed income, in that it's a great way to elicit market premia and complexity premia from the markets. It's also going to be the same for equity markets, where passive will probably underperform active depending on the style of investment. So hence, knowing your managers better and investing into these different styles is needed.
Yeah, I mean, Alex, you've obviously come from the institutional space, as I have, and And one of the points raised there that you've both raised is that the optimal portfolio for the sort of clients we're talking to today is actually very different from what a big super fund or a big institution would have to invest like, because they've just got so much more money to invest. They can't invest as dynamically as Jesse just outlined. They can't access some of these smaller, more nimble boutique opportunities. I mean, how do you perceive that issue? And you know, what are the things that you think investors that we're talking to today must do in order to get better results going forward and to differentiate themselves and take advantage of their smaller size?
I guess if you stop thinking of them as the peer group, that's probably a good start. But they're not going to have exposure to smalls. Like you know, Aussie Super might hire internalise a small caps Aussie manager team, and they'll max it out at $400 million of fund, and it means absolutely nothing for the Australian super portfolio other than they can write a media release that they have a small cap PM. Like so that matters a lot. You know, you don't like when we're looking at fund managers and when you're looking at like equities fund managers, you don't pivot to, oh, these guys are massive. Like they have no capacity to invest dynamically. Let's invest with them. So you know, look at what your advantages are. Like our advantages are small managers, nimble managers, managers that are growing, being dynamic. Their advantages are they can buy 2% of Heathrow and it's not mark to market every quarter, or they can buy Misky World equities at less than a basis point. There's just different, it's apples and oranges. We're not playing the same game, even though we invest in the same markets. It's not really the same game.
Yeah, okay, no, terrific. And so the biggest opportunity to improve, I mean, just further to that, what do you think the biggest opportunity is to improve portfolio management in Australia at sort of, you know, the advisory level that we're talking to today? Do you guys have some thoughts on that? You know, obviously you've got a whole bunch of advisors moving to bring in specialists to help them manage their portfolios, groups like us, I guess. But you know, what are some of the other advantages you think? You're using their size, making sure they're not peer benchmarking themselves against something they don't need to be, that they're actually using their advantages, as we talked about. There are things that people can do to really, you know, boost their performance. Access, you know, one thing I'd add there is access the global opportunity set in boutique management. Don't just be sold by what's in Australia, but look more broadly, look more globally in terms of finding, you know, terrific active managers. Of which there are very many around if you're prepared to look hard enough and do your work. But obviously that's a labour-intensive exercise. But you know, what do you think the biggest opportunity is for Australians to sort of improve their opportunity set and create better portfolios and more robust portfolios going forward, given the more challenging environment we may well be entering into?
I think there's definitely a lot of low-hanging fruit around sophistication and technology. So managed accounts obviously facilitates a lot more time at the advisor level in terms of stepping away to some extent from the investment decision-making process and outsourcing that to people who do it full-time as a day job. So there's definitely low-hanging fruit from that perspective. And there's also the emergence of boutiques and sophisticated consultants, etc., gives them the same, I would suggest, intellectual firepower as some of the bigger funds in terms of their ability to implement good asset allocation solutions, rather than I say trying to like keep up with that arms race themselves while they're trying to generate a client base, keep clients happy, you know, do all the other work that planning groups and planners actually do.
Yep. Jesse, do you have any thoughts on that?
If I can jump in slightly, thanks. It's probably also increasing exposure to the global set. And you said that quite rightly, Jerome, in your intro to the question just then, because if we do have a home bias for Australians, and if we can access products that allow us to, one, we don't have to worry about the currency volatility, so being able to be involved with or access active managers, rather across managed accounts or even in managed funds and ETFs, for example, they're able to hedge off the FX risk. There are ample opportunities for Australian-based investors to invest globally into areas they don't know about. And to come to Alex's point as well, accessing boutiques. And so you look at, you know, a capital markets line such as what I have or Alex has, or, you know, the others are out there from the BlackRocks or PineBridges of the world. we all come to a very similar view that places like Spain and France might have ideal equity markets for us to invest into, but how many Aussies are probably invested in Spain or in French or Italian equities? Probably next to none. And the same thing when it comes to, say, Japan. We know that Japan is quite a large value market because of the dispersion among industry sectors compared to, say, Australia. But how many people listening to the call would have increased their allocation, or if they even had any allocation to Japan this year, when we've seen this cyclical rotation from growth into value stocks? And I would argue from my point of view that next to no one's doing that. So hence, knowing a bit more about global asset allocations and taking advantage of that is definitely going to be advantageous going forward too.
Yeah, look, I mean, definitely you need those specialist skills, don't you, on board to be able to do these things, and the dedication towards these efforts. But you also need the governance and the willingness to do them, as pointed out, with respect to, if you're peer benchmarking all the time to the old 60-40 approach as opposed to your real objectives of clients, and that's a big issue, right? That's one of the biggest things I perceive is just that willingness to move away from let's run a portfolio like everyone else to let's just run a portfolio that matches what we're actually trying to do for clients. That's a big step, and not many people have been prepared to take that step. I'd argue in Australia that's quite a brave step to take, but it's a very necessary one if you want to actually build more robust and more optimal portfolios, I'd suggest. Well, look, we're coming close to the end of the session. Is there anything else that you guys want to really, one question we have here around, around endowment portfolios and much greater allocations to alternatives and so forth, and what people see. I mean, just in terms of some of the issues with allocating more to alts, what are you seeing out there with the clients you're aware of? How much are they allocating to alts? How much should they be allocating more to alts, and how do they go about doing that? I guess in terms of some of the considerations and issues they need to sort of resolve before they can allocate more to more diversifying assets.
I'd say like Swenson, he had a massive first mover advantage, right? Like the Yale endowment model is not going to be replicated by anybody else again, because they were the ones who came up with the Yale endowment model. Vintage year, or like alts, private assets, vintage year matters so much. The good ones are closed. Just dispersion of manager performance is enormous. You can't just say I'm going to load up in alts and replicate what successful endowment managers have actually done.
But I mean, Alex, to your point, the dispersion is very big in alts, and that's the opportunity, right? If you're actually able to, if you're really wanting to be active, and you rate yourself at being active, that's actually the opportunity within hedge funds. Some of them go up a lot, some of them go down a lot. And if you're able to pick the better ones on average, then you're able to do very well. And that's what it's supposed to be about: true active management, right? Not actually getting the passive benchmarks results sort of thing.
Yeah, if you can actually get access, I guess, to these massive sort of PE vehicles at 2009 vintage years. So there's definitely
it's not all PE. Of
course. No. Otherwise, like I obviously mentioned CTAs before, right? Like, so there's issues with historical performance of CTAs versus the kind of market structure we have now, where drawdowns now tend to be quite fast relative to previous drawdowns outside of 87. And ARP, like every super fund in the country hired ARP people after the research started coming out. By ARP, alternative risk premium, and then I think a lot of them are actually winding that down because the sort of ex post performance of a lot of those sort of strategies has suffered. But I think if you can find, and we have alternatives in the portfolio, we have alternative defensive assets and we have alternative growth assets. It's just not buying beta. You can't just throw money at a bucket and assume it's actually going to do well.
You've got to do that. You've got to do the due diligence on
for sure
strategies. You've got to have the skills to do that. Jesse, do you have views in terms of how you access those alternative opportunities? And we know we need them in portfolios. I mean, everybody who's been on this in session 1 and session 2 has said, look, we need more alts. So what are how do we actually do that?
And so it's hard, right? Because you basically need an investment platform. And now I can speak because I've got one that works behind me at Mason Stevens, but you need an investment platform that allows you to access some of these opportunities. And because alts come in different forms, in some cases they can be, for a self-directed portfolio or for even just specific types of IMAs, SMA structures, they might have lockups. for example, if we're talking about venture capital or private equity, which might not work for some people's liquidity requirements or an SMA structure, but to be able to just have access to these things or these deals is going to provide levels of outperformance, whether it is a private equity deal as a once-off, or to be able to buy RMBS, or to be able to buy XYZ venture capital fund, or that thing that's just listed on the ASX, for example, that might provide you some kind of ETF access to an alt. Things people didn't know about, they might not know exist, and they need to have access to good sources of information, such as, well, I suppose, just like us on the call, that it's part of our business model is to be able to provide access to people that they didn't know existed, or to new products as they come up, and that we have the teams behind us that enable us to then go, hey, this might be relevant for you.
Okay, terrific. There's certainly a lot more opportunity to do more in alts and allocate. I'm certainly in the portfolios that I'm managing with Dynamic Asset and WealthLander, we have substantively more allocations to alts and have been very successful with doing that. But I think that's something for people to think about, how they best get that access and take advantage of that those opportunities for greater diversification and simply playing the old 60-40 bond equity game. But even within the bond equity game, as we've highlighted, there are opportunities to be more dynamic, to really go down to a more granular level in terms of the assets you're sort of looking at, as we've sort of talked about in these sessions. And there's certainly a lot to think about. Look, I'd like to thank both of you for being on this session. I hope that everybody's got something out of it. I'd welcome feedback and see how IMAP can and ourselves can improve our future contributions to the industry with these sorts of sessions. So thanks again, gents, and we look forward to seeing everyone in future.
Thanks for having me. Cheers.